Well, good morning, everyone, and welcome to this week's or this month's webinar. Sorry for the slightly late start, albeit that we're starting half an hour earlier. Just had a few gremlins in the system, which turned out to be user error, as they generally do. So thank you, everyone, for tuning in. I'll run through the system. Most people will be aware of it, but I'll run through it nonetheless. There is a chat function, which some of you have already punched in. I can see obviously some questions there about why you can't hear me. That was obviously our fault. On this, also on the side, I will share the slides from today with everyone. You should have got these already, but there is a button there for files, and you can download the paper in a PDF form. For those of you who are joining us from the West and attended our LRC workshop last week, thanks for tuning in. We had a really great time over in Perth doing our one-day workshop. And I know from the feedback we've got both on the day and also in email correspondence since, everyone seemed to enjoy the day. For those of you in the eastern states, we'll be doing our roadshow next week. So we're in Sydney on Tuesday, Brisbane on Thursday, and the Gold Coast on Friday. At this stage, we don't have any more seats available in Sydney. There may be a few seats left in Brisbane, and the Gold Coast has some as well. So if you're in those areas or you want to make a trek to the Gold Coast, please get in touch with us about coming along, and we'll try to fit you in. So today I'm going to hand you over shortly to Sean Jones, who's a solicitor in our Brisbane office. Sean works closely with Brett Hart, but also myself, and does a whole range of commercial activities and estate and succession planning. Sean's going to talk to us today about one particular scenario for property joint ventures, but it can obviously be, I guess, adapted for a whole range of different activities in that space. So I'm going to hand over to Sean.
Thank you, Paul. So as many of you are aware, in the current climate, there is a lot of property development going on, increases in property prices across the country. So accordingly, in these times, we're usually approached by clients who typically would have a house block on a large plot of land that is largely unused, and they're usually approaching us with the view to developing and selling that land. Now, in those circumstances, there are a number of tax traps we've got to look out for, and it's critical to put in place a structure that's going to protect our clients and ensure that they can really maximise on the after-tax returns there. So today we're going to look at some of those tax traps with one-off property developments, and then look at our recommended structure, which is an unincorporated joint venture, giving you a brief explanation of what that is, how that works, and how it compares to partnerships. Then we'll look to how we structure the joint venture agreements, particularly so that joint venture isn't classed as a partnership and why that's a risk we want to avoid. And then we'll look to the tax outcome for landowners who utilise that structure. So as I was saying before, a typical scenario we'll come across is a mum and dad investor with a house block on a large plot of land that they'd be looking to cut up and develop into either other house blocks, townhouses or units to sell for a profit. Ideally, in that scenario, we want to make sure that land, once it's subdivided and sold, the clients can still retain access to those CGT concessions, particularly the 50% discount. And it may also be the case that the clients are also looking to retain one of those lots to continue to live in or to rent out. So our focus in those circumstances are to do what we can to maximise the after-tax returns and avoid any adverse stamp duty and deal with GST that arises from the sale of developed lots as well. So before we get stuck into the recommended structure, it's important to understand the key risk and why we recommend it. And to do that, we need to delve into the history a little bit. So, as many of you would know, prior to 1985, there was no tax on realising a capital gain, merely tax on income derived from profits. So, accordingly, if you made a capital gain prior to 1985, you wouldn't pay tax on it, which brings us to a key case there regarding a property development. That's the Federal Commissioner of Taxation and Whitford's Beach Proprietary Limited. And given that there wasn't capital gains tax at the time that this case was heard, the stakes were even higher for the taxpayer in question. So in this case, the taxpayer company was formed in 1954, carried on other activities, not property development, and acquired a land, pretty large parcel there. And this was for the purpose of securing access to a beach for fishing shacks. And over time, what happened was that land increased substantially in value, which the shareholders then recognised. And on the 20th of December 1967, the shares in that taxpayer company were transferred to new shareholders. And those shareholders amended the object of the company in the articles, which is the company constitution. And the object of the company was changed to a business being carried on for the development, subdivision, and sale of land. And the reason why they amended the company object was back in the day, you had to state specifically what the company object was, or else the company could engage in activities that were relevant to that object. So subsequently, once the taxpayer company here changed the articles to developing land and subdividing it, that land was subsequently developed, subdivided, and sold for a significant profit. The taxpayer company obviously wanted to characterise that profit as realising capital asset, whereas the Federal Commissioner of Taxation disagreed with that view naturally, and wanted to hold that the taxpayer company was carrying on a business, and the profits from that business, being the sale of those developed lots, was taxable income. So the outcome there was that the court paid particular attention to what was done on the 20th December 1967, especially the amendments that the shareholders caused to the company's articles, and held that essentially the taxpayer company transformed from a company which held land for domestic purposes of its shareholders to a company whose purpose was to engage in a commercial venture with a view to profit, meaning that the proceeds of sale of those subdivided lots was treated as taxable income, not merely realising a capital gain, which had significant consequences for the taxpayer in question there. So some of the key issues that arise from this case, and what the court really focuses on in these circumstances, is they look to the purpose of originally acquiring an asset, whether that purpose was to carry on a business with a view to making a profit or some other domestic or personal purpose, whether there's been any change in purpose over time, such as we saw in that case there, where the taxpayers have gone from what was originally a domestic or personal purpose to a profit-making one, and how this compares to acts done by a taxpayer merely to realise the value in the asset, which in those circumstances means that the asset, the proceeds of sale from that asset would be treated as just a capital gain rather than taxable income. And one of the key issues that arose from the Whitford's case and moving forward was trying to pinpoint at what point in time that a asset goes from being treated as a capital asset to a revenue asset, depending on how the taxpayer treats that asset and whether there's been any change in purpose. So a significant consequence from that case was that even where the taxpayers only developed and sold land as a one-off or on a relatively small scale basis, even that transaction can be held as carrying on a business, and subsequently that means that the proceeds of sale from that development would be treated as taxable income, taxable ordinary income, rather than a capital gain, which means critically for the taxpayer that they lose out on being able to obtain those handsome CGT concessions. So as we were discussing before, typically on the tax on the sale of an asset will either be classed as ordinary income or as statutory income, being here capital gain subject to CGT. So as we looked at with the Whitford's case, the profit from a transaction will be held to be ordinary income when the asset was acquired with a view to making a profit, or the transaction to sell the asset was done with a view to making a profit, or that asset was sold as part of the business being carried on to make a profit. So the approach post the Whitford's case has usually been to tell the clients to transfer that land to a related entity that they set up, which is usually a discretionary trust or a company. And then that discretionary trust or company would develop and sell that land onto the customer. So the key benefit there is to really crystallize the point in time when that asset can still be held as a capital asset and the clients can retain their access to CGT concessions, as opposed to them developing and selling the asset themselves and losing out on those concessions, because it's then held to be taxable ordinary income. Now, the only problem with this approach is that the developer entity that they transfer this land to is going to have to pay stamp duty on that transfer. And in the example we're given there, obviously stamp duty differs between states, but it's going to be a fairly significant amount, well over $60,000 on the example here. The other issue is the clients, the landowners would be liable for capital gains tax on that transfer of the land to the related entity. So consequently, if there's any changes in the market between the time the clients transfer this land to a developer entity and then when that entity finally subdivides and sells those lots, there's a real risk here of the clients being left with a significant CGT liability and the developer entity with a stamp duty liability before we've even got to the point of selling those developed lots. So in the example we gave there, so if we have a couple that have purchased their acreage home in 2000, valued at $300,000, and now the surrounding area is ripe for development, the land value has increased substantially, and then they were to transfer that land to a developer entity, there's going to be significant capital gains tax initially for John and Penny when they transfer that land, and then their developer entity is going to be liable for significant stamp duty before we've even sold this on to the customer. So the objectives here, and what we really want to aim to do when clients approach us with land they're looking to develop and subdivide, is to first limit the liability of the landowners, because clearly development and subdivision of land isn't a quick or simple process. There's a lot of contractors engaged, a lot of risk carried with the activities there, and that on flows to any sales to customers where they weren't expecting, or that they just had issues or weren't expecting. The land they purchased wasn't what they expected, and there's real risk there of being sued. So we want to limit that for the landowners. We also want to make sure that for the purpose of our landowner clients, they're able to retain the capital nature of that land, and then use that to apply any like CGT concessions, particularly the 50% discount. Then we want to crystallize and sort of separate what we would class as the ordinary income being made by that developer entity when it develops that land and sells it for a profit. And then, of course, if that developer entity is a related trust, it can distribute that profit fairly flexibly. And of course, the key is we want to maximize how much of those proceeds we can class as capital. So our approach, rather than the typical post-Whitford's approach, is to set up an unincorporated joint venture, which is essentially a contractual relationship between two or more persons, our venturers. An unincorporated joint venture isn't a separate entity at law. The rights and obligations between the venturers critically are different and distinct, and that's fixed by the terms of the agreement between them, our joint venture agreement. And it's critical that we structure that properly so that unincorporated joint venture isn't classed as a partnership. And there's a key difference there, which we'll go into. So a partnership is essentially two or more people carrying on a business with a common view to profit there. So each partner involved in that sort of relationship is actively involved and responsible for that business being carried on. It also means that each of them are jointly and severally liable for any debts or risks carried by that business. And critically, it really defeats the purpose of setting up this structure with a view to retaining that capital nature of the asset in the hands of our landowner clients. Because if they're held to be in a partnership and we don't structure that agreement correctly, then they're held to be carrying on a business together with that developer entity rather than separately. So first of all, they lose out on the CGT concessions, and that sale of land is still going to be classed as ordinary taxable income. Our landowner clients then also jointly and severally liable for any debts or claims that arise from the activities of our developer entity. And there's also a need to lodge a partnership tax return as well. So it's quite critical there that we structure this arrangement properly so that we can clearly and distinctly separate the rights and obligations between our two parties so they're not classed as a partnership. So as we're discussing there, we just illustrated the ideal structure. So there would be our developer entity, usually a discretionary trust, that enters into a joint venture agreement with our clients as individuals, our landowners who are merely going to have a passive role in the arrangement. We want to make sure that they're not doing anything active that can be held to be carrying on a business. And then, of course, they will together sell this land to our third-party purchasers. So in the joint venture agreement, as I was saying before, it's quite critical. We want to take steps to ensure that it isn't characterized as a partnership. First, one of the key issues we come across where people often use the terms joint venture and partnership interchangeably, and that's incorrect. They're two very distinct arrangements, and we often see people attempt to structure an arrangement as a joint venture when in actual fact it's a partnership. And one of the factors there is to determine whether the parties to that arrangement are taking a portion of gross receipts from that arrangement as opposed to a share of the net profit. If it's a share of the net profit, then it's more likely that that arrangement is going to be classed as a partnership. The parties in that instance are taken to be sharing the debts together and essentially carrying on the business together. So that's one critical factor. Another is, of course, as I was saying before, to clearly separate the rights and obligations of each party, to state that the landowners are strictly taking a passive role and holding the land there for the benefit of the developer entity. And then our developer entity is taking the more active role of engaging with subcontractors and council to develop the land and really doing everything that can be classed as carrying on a business with a view to making a profit. So the landowner duties in our joint venture agreement will be purely limited to the following. So we want to state that they will continue to hold that land for the benefit of the developer entity. So they're not going to sell it to a third party in the meantime, that they will allow the developer access to the land to carry out works. that they will consent to any development applications made by their related developer entity. And then, of course, given that they will still be the landowners on title, they'll need to consent and execute transfers of the developed lots to third-party customers on behalf of the developer entity. And of course, these obligations are strictly passive. They're not doing anything that could be actively seen as developing the land to for the purpose of making a profit. And meanwhile, our developer entity will basically take on all the active obligations and role of developing that land and subdividing it. So they, of course, will be applying for government consents and council approvals for the development, engaging with subcontractors to develop the land, obtaining finance if necessary for the project, and then, of course, conducting a marketing campaign to sell the lots. So basically all the activities that can be seen as carrying on a business. So looking back to our example and our outcome there, if we properly structure this agreement and have it in place, we've ensured that our landowner clients are not held to be developers undertaking a business there to making a profit from the development and sale of the land. And accordingly, if we do that, that means that whatever receipts of sale we receive from those developed lots, the landowner's portion of that is going to be classed as capital, which means that we can apply the CGT concessions, in particular that 50% discount, and then that our developer entity is the one that makes whatever's left over from the value in land, and the increased value from the development is then classed as our ordinary taxable income in the hands of our developer entity. And one method of really ensuring and pinpointing that the portion of the proceeds received by the landowner as capital or realizing capital is to get a market valuation of that land at the time that we're entering into that joint venture agreement with our related developer entity. So that way we can really capture and crystallize the amount that's going to be held as capital, as opposed to the excess that's likely to be held as ordinary taxable income. So there, in those circumstances, as we just went over before, the tax in the hands of the landowners will be capital proceeds that we can reduce by our CGT discount, which means we're effectively getting half of it for free. With the main lot, if they weren't retaining it and were instead selling it, and that was under 2 hectares, the landowners would also be able to claim the main residence exemption, which means that effectively they wouldn't be paying any capital gains tax on the sale of that lot. As for our developer entity, there's no stamp duty that they've had to pay, alluding to the earlier example of the typical approach taken post-Whitfords. So because there's been no transfer, there's merely being an agreement entered into between our landowners and the developer entity, there's no stamp duty payable by the developer entity. So we save out big time there. And then whatever income's derived by that entity from the sale of those lots, that'll be what's classed as ordinary income. So there, of course, just recapping before and our objectives, what we've achieved there is we've effectively limited the liability of our landowner clients because they've taken a purely passive role. They're not doing anything active. That would attract significant risks of being sued or being liable for any of the debts that the developer entity would incur in carrying out that development. We've maximised our CGT concessions to ensure that we can really maximise the after-tax return for our client, and whatever excess profit that's received by our developer entity, if it's a discretionary trust, can be distributed flexibly as well, so we can find further savings there. Now, one thing we do have to address as well, when we're engaging in this sort of activity, it's important that we address GST. So here in our example, the joint venturers will be subject to GST on the sale of those developed lots to our third-party customers. There's a broader meaning of enterprise in the GST Act as opposed to just carrying on a business. So as we've sort of highlighted there, an enterprise is defined in the GST Act to be any activity or series of activities that's done in the form of a venture or concern in the nature of trade, which is a very broad definition that goes far beyond just carrying on a business and would capture the arrangement here, even though our landowner clients are only taking a passive role. So accordingly, they will both have to be subject. They will both be subject to GST, and they will have to register for GST. So as we were just saying, the landowner and the developer will be carrying on an enterprise. The development and sale of that land is a taxable supply, and GST will apply to that share of proceeds, which brings us next to some of the issues surrounding that. So as from 1st of July 2018, when we're developing and selling new lots of residential land, the purchasers of that land are required to withhold 1/11 of the purchase price, or 7% if we were applying the margin scheme, which we'll get to in a moment. And that is remitted to the ATO at settlement. So the whole idea of GST there under this regime was really flipped on its head. Typically, we would have our landowner clients collecting the GST at settlement, but once this regime was brought in from 1st of July 2018, really the purchasers are now obligated to withhold that GST amount and remit it straight to the ATO rather than paying it to our landowner clients, which really makes it all the more important that both the clients and the developer entity are registered for GST so they can claim a partial refund of whatever amount was remitted to the ATO in excess of what was payable on the sale. So another issue we'll want to address is the margin scheme. So effectively, the GST margin scheme imposes GST on the difference between the sale price of our land and the original purchase price that our clients paid for it, rather than applying GST to the total sale price. So to explain that in our example here, say if we have landowner clients that have purchased land for $500,000 and then they develop and sell that for $1 million. So normally GST would be 1/11 of the sale price. So there in our example, that's about $90,000. But under the margin scheme, if they've acquired that land for $500,000 and we take that off and apply GST to the difference, we see there the clients are only paying 45 or a bit over 45,000 in GST. So quite an attractive scheme that we want to use here in these circumstances if we can. And to do that, effectively there needs to be a taxable supply of property, which there is here. And when we're developing and selling property, that is carrying on an enterprise and we are making a taxable supply. There would be an agreement in writing between our customer buying the developed lot and the landowner selling it to apply that scheme. And then this will apply to any supply of property that was acquired before the 1st of July 2000. As for any properties acquired after the 1st of July 2000, most of them will probably be eligible for this scheme, so long as the original seller wasn't required to register for GST if they weren't making a taxable supply, and typically they wouldn't have if we were just buying land from other homeowners or even investors there, except for a developer. And if they were purchasing from a developer originally, then it's usually the case that developer would have applied the margin scheme there. If they hadn't, then we won't be able to apply the margin scheme here. But in most cases, we would be eligible for the margin scheme. So in some circumstances, our we'd approached by clients who would be looking to develop the land and then retain one lot to either live in or to rent out as an investment for themselves. So clearly there, under our proposed arrangement, once they enter into this joint venture, there's no transfer of that home block, as we'll call it, to the developer entity or to any third party. So there's not going to be any stamp duty applicable to our clients if they choose to retain that lot. Subdividing a lot isn't a dutiable transaction, so there's no stamp duty that applies there either. Now, if we have a developer entity that is claiming GST input tax credits on the development, then there's none that can be claimed in relation to that home block if there's, say, works done to improve it, because at the end of the day, that's still going to be held by our clients for a private purpose. And then just looking to capital gains tax. So subdividing lots isn't a disposal of a CGT asset, so it's not a CGT event A1. And we've actually got a specific carve-out in the Income Tax Assessment Act for a split change or merger of a CGT asset, which would apply here for a subdivision of land. So essentially, if we have clients that are subdividing land and they still own those subdivided lots after the subdivision, which they would in our circumstances here, then there's a carve out there where CGT won't apply to our landowner clients until they actually sell those lots to the customers. So that's really to ensure that they're not being hit with capital gains tax twice. They're only having to pay it once that subdivided lot is actually being sold to a customer. So to summarize there and look back to our proposed arrangement, if we have a properly structured unincorporated joint venture agreement in place between our landowner clients and a related entity, then we've separated the roles of our clients and the developer so that we can retain the capital nature of the land in the hands of our landowner clients and apply the attractive CGT concessions there, and also limit their risk in relation to the development and sale of those subdivided lots. And then that leaves our developer entity really carrying on the risk there, receiving business income, and then there's some flexibility for our trust in distributing that income. So really the key people who benefit here are our landowner clients, because they reduce obviously that significant increase in land value by those CGT discounts. And this is suitable usually for clients that would be living out rurally or in an urban area that's become ripe for development, or they've inherited a large parcel of land from parents or grandparents, and that land is largely unused and they're looking to really capitalize on that. And look, in our example, we've really honed in and focused on, say, mum and dad investor owning a home block on a large plot of land that's largely unused. But this can apply to a number of situations, such as where we've got clients and, say, neighbours that between them have a large lot of unused land, and they're together looking to basically maximise their profits there. So same arrangement would apply in those situations, or even in some cases where our clients are approached by a developer, or they approach a developer, and the developer doesn't have the finances available to buy the land outright from our clients. So instead, we would impose an arrangement such as what we've suggested here to ensure that our landowner clients can still apply those CGT concessions, and the developer then pays tax on their profits from that venture. So that pretty much sums up our recommended structure there, and we'll just now turn to any questions that you have.
So, Sean, we've got a couple of questions come in. I'll give you the first one. can the landowner share in any upside in the proceeds over the market value of the land at the time of entering the joint venture?
So, possibly, but you'd want to really crystallize that point, because the whole aim here really is to make sure that we can maximize that return by ensuring that whatever the landowner client gets, that's capital. And really, that a key indicator of that is going to be the market value of that land at the time that they enter into that joint venture agreement. So, we could try to increase that beyond, but we're risking there that a portion of that increase from the development is going to be classed as income.
So I guess the other thing to remember there is that in this scenario, the clients control both sides of the deal, so to speak. So they are the landowner, and they also are probably the directors of the trustee company operating the developer entity. So obviously they will share in all of the proceeds of the actual development. If it were with third parties, then you may structure a profit share on the development side as opposed to, I guess, the land owning side. I'll go to the next question, and I might even answer it myself. What is the risk of Part 4A being triggered by this arrangement? The risk is very low. Whenever you're looking at Part 4A, there's required now to be, I guess you need to come up with your alternate postulate, they call it. And essentially the alternate is the traditional approach: transfer the property, capitalize or crystallize the capital gain. The clients obtain the benefits of that capital gain, being that it is a capital gain, and obviously depending on what concessions are available, that would be the alternative to entering into this arrangement. So in that scenario, there is no tax benefit available to anyone. Yes, there's a stamp duty saving, but that doesn't come into I guess the tax benefit. Next question is, could we have a quick case study which addresses the market value at the time of the JV and the main residence exemption? Do you want to take that one, Sean?
Yeah, so say if we have just a block of land that was 2 hectares, and we were wanting the clients say that was purchased for $500,000. It was worth just prior to our joint venture agreement, say $1 million, and we get a market valuation to that effect. And then beyond that, say after the development and sale of that land, there was an additional $500,000 made there. So the additional $500,000 would, of course, be ordinary taxable income in the hands of our developer entity, and the $1 million made by our clients there, of course, reduced first by the cost base. We have $500,000 left over, and then if we're within 2 hectares, then we can actually apply that main residence exemption and potentially get that gain tax-free, or if not, there would be a discount that would apply to at least reduce it by 50%. And that's really the key benefit here, is that portion of the proceeds of sale for the development is, if we apply those concessions, is a huge benefit to our clients.
Yeah, generally, how it works in practice is that a block of land is carved up and potentially sold as, a 6-pack of units, for example. So you do a market value appraisal at the beginning of the joint venture, and when the block is split up and developed, each time a sale occurs of a unit, 1/6 of the market valuation goes to the landowner, and the difference in the contract price between that amount and what is received goes to the developer. That's kind of, I guess, how it works. And then as each of the separate lots are sold, the landowner takes their portion of the market value at the time of the joint venture, and the balance goes to the developer. So the next question, Sean, is this an unincorporated association joint venture, does it register for GST, or are they just or JV partners? Does the JV entity lodge a tax return? Which entity, or which type of entity, partnership, company, or trust?
Okay, so we have an unincorporated joint venture here. So there's no tax return being lodged by the joint venture. It's that we have tax returns being lodged by the parties to that venture. So on the one hand, our clients as individuals, and on the other hand, whatever entity they set up, whether that be a company or trust. And each of them will lodge a tax return noting whatever they've received from this development. So in the hands of our developer entity, they'll be lodging a return there, noting, of course, the portion of proceeds they've received from the development, which will be our ordinary taxable income. And then our clients will be lodging their individual tax returns, noting that that's a capital gain that they've made from that venture, and then applying whatever concessions we have available. So there's going to be, they're basically going to file their own tax returns, and we're not filing a joint tax return for the venture here. So that's really the key point of difference between an unincorporated association and a registered joint venture or a partnership, effectively. And in terms of GST, both the landowner clients and the developer entity will have to register for GST. Our clients are the ones making the taxable supply when that land is transferred to the customers. So they will have to be registered for GST to obviously claim back what's remitted to the ATO. And then our developer entity will want to be registered for GST so they can claim any input tax credits on the development itself, such as paying legal fees or subcontractors to come in and develop that land, construct buildings, anything there. So both parties will need to. And we did consider whether you can form a GST group there, but it doesn't really work for our scenario, because if you form a group there and try to park it all with one entity, that entity has to be making the taxable supply as well as claiming the credits, which isn't the case here. It's just because it's our clients as individuals making the taxable supply of land rather than the developer entity. So it just means that we don't get to form a group, but that doesn't mean that doesn't have any significant adverse consequences. It just means that the clients and the developer entity have to register for GST.
Thank you, Sean. Scott was the person who asked the question and then answered it for himself in the box, but pretty much what you've said in the chat there, Scott, is spot on. Sean, regarding the example, the landowner will be required to register for GST. Yes, that's right. And pay GST on the $1 million proceeds, ignoring the margin scheme.
Yeah, that's right. If we were going to ignore the margin scheme, that'd be up for a significant amount of GST, which is why we really want to make sure that we're eligible for that margin scheme, and we will be in most cases. It's be pretty rare to come across circumstances where our clients couldn't apply that scheme to the sale. Like I was saying in the webinar, typically the clients would have purchased that block of land from another private seller, homeowners themselves, or just investors that own the one block, or if it's a developer entity that's subdivided and sold that lot to our clients originally, then it's often the case they would have applied the margin scheme themselves. So in most circumstances, our clients will be able to apply that scheme, because obviously, as you sort of pointed out there, there's a pretty significant amount of GST to pay if we can't apply that scheme.
So the next question, each of them are good questions, but they require a bit of answering. So the next one, case study, initial land has $1.5 million value. Developer invests another 1.5 to build 4 townhouses. At the end of the agreement, landowner and developer retain 2 houses valued at 1 million each, I think that should read. So the landowner has increased the value by 500,000 each, I think. When the landowner sells, does that 500,000 increase get CGT discounts? It might be easy. I had a bit more time to come to that. Yes, that's essentially what we're saying, but you have to remember that there's probably 2 extra things to consider. One is your developer entity needs to be a trust in that scenario, because obviously Division 7A would come into that if the developer, I guess, developed the land and didn't charge market value for that development, then Division 7A would come into play there. Secondly, the increase in value is going to have probably only the 50% discount unless they move into one of the properties, I presume. There'll be some level of apportionment there. But yes, that is what we're saying, that the CGT discount can apply to those. Next, if the landowner registers for GST, then you're saying they're carrying on an enterprise, yet it is a CGT event. How does that work? Plus, do mum and dad register for GST as a partnership? I think the first part of the question, if the landowner registered for GST, then they're carrying on an enterprise, yet it isn't a CGT event, I think is maybe what the question is. That's right. So the definitions, notwithstanding they might have some overlap, they are standalone definitions. So the definition of enterprise is extremely broad and will take into account circumstances that are outside of carrying on a business. So what we're trying to do here is to say that mum and dad as the landowners are not carrying on a business. Therefore, all they're doing is merely realising the capital value of their asset. But the definition of enterprise captures that. In terms of mum and dad registering as a partnership for GST purposes, to be honest, I don't know the quick answer to that. Possibly, I'd need to look into, I guess those specifics. Oftentimes, that's something that you as the accountants manage for us, and we don't get asked that question a lot. So I might make this one the last question. Any that we haven't got to, I'll try to get to after. But if both mum and dad are the owners of the trust, that is the other joint venture participant, does dad register for GST and does mum register for GST? Well, I think that kind of is probably leading into the earlier question of whether they register as a partnership or register as individuals. And again, the short answer is I don't really know the answer to that, but I'll have a look and I'll circulate it to everyone. I might cut it off there. Thank you, everyone, for those really great questions, by the way. They all had a lot of thought put into them. Hopefully, we've answered them to your satisfaction. If you want to get in contact with us after in relation to any of your clients, please do. There will be a feedback survey that will come out in the next few hours. If you could put in some feedback and any other topics you'd like to hear about. If you're coming to our one-day workshops next week in Sydney, Brisbane or Perth, please feel free to make yourself known to me, come up and say hello, or to Sean if you're in Brisbane. We're really looking forward to giving those presentations next week. There will be a webinar next month. We don't have a topic as yet, but the topic should be known in the next week or so, and we'll put that out. But thank you, everyone, and keep those questions coming through. We'll try to get back to them in an email. All right, thank you.